me pass it on to Ashok.
Thank you, Sunil. A very good morning to all the participants in the call. I am happy to share with you that Happiest Minds has continued to deliver industry-leading performance, growing 3.6% sequentially in constant currency. On a revenue growth plus EBITDA, we were at 38.9%, which is another quarter of superior performance. Our EBITDA margin at 24.5% has been well above our guided range of 22 to 34%, and this is now for the 14th quarter in a row. We crossed two significant milestones during the quarter. We completed 12 years as a company, and we completed 3 years as a public entity. I would congratulate all the stakeholders who have contributed to and been a part of this journey and express my gratitude for your continued support. During the quarter, we raised capital through a QIP, and I also sold a small portion of my equity at Happiest Minds. Both these events led to a small dilution of my equity interests. The latter was primarily done to fund the capital requirements of SCAN, the not-for-profit medical research entity that I started, and also to enhance the capital structure of Happiest Health. This capital infusion for these two entities should take care of their requirements, their capital requirements for the medium term. As part of my commitment and belief to have Happiest Minds exist in perpetuity, my controlling interest in Happiest Minds will not be allowed to go below 40%. I should also clarify that my current shareholding percent of 51.3% is safely well above this threshold. While many companies in our industry are seeing a declining headcount numbers, we in the quarter have added 237 Happiest Minds to our teams, in line with our commitment to work and execute on our larger vision to be a billion-dollar enterprise in sales by FY31. In quarter one, we had given a revenue growth guidance of 25% without making a distinction between organic and inorganic growth. Based on an assessment of the market dynamics, we are revising this growth guidance for the year to 12% on an organic basis. Additional growth, if any, due to acquisition, will be over and above this guidance. We retain our EBITDA guidance of 22 to 24%. I am now happy to announce a major new organizational and strategic initiative for Happiest Minds. In order to avail of the transformational opportunity being presented to the entire industry, I would say, and to every industry through generative AI, we are creating a new business unit called Generative AI Business Unit, which will be abbreviated as GBS. This will become a new engine of growth, and it will require a lot of collaboration because the sales will take place through the entire organization and through every industry group. Accordingly, we have selected Sridhar Manta as the President and CEO of GBS. Sridhar is a Happiest Minds stalwart since inception and the best person to lead this in view of the interactions and collaboration that are required. Sridhar will be the initiative will be led further by Rajiv Shah as a member of the executive board. While we are doing this, we are also integrating our existing PS and BBS businesses into one combined business called PDES, and this will be under Joseph Anantharaju, who has led our most successful business unit up till now. There will be no change in IMSs. Therefore, we will retain our three BUs, PDES, IMSs, and now the third one will become GPS. We believe these three engines of growth will take us forward to our future goals I do want to emphasize again, though, that since it will take time to build up the whole organization in GBS, there will be no meaningful revenue until the beginning of the next financial year. And accordingly, we will only start reporting their numbers once that new year begins as a part of a plan that we will draw out. Let me conclude my commentary by wishing all on this call a very happy Navratri. And with this, over to you, Venkat.
Thank you, Ashok. A very good morning to all of you on the call. Wishing you and family a very happy Navratri. The next few minutes, I will take you all through the financial performance and certain key operational highlights for the quarter and the half year that ended September 30th. For a start, amidst all that's happening in the world, I'm very grateful for the place we are in. Coming to the financials, very happy to share that our total income for the quarter for the first time has crossed the 50 million mark. Total income for the half year at the same time has crossed the 100 million mark. Now coming back to the quarter, operating revenues at 49 million grew sequentially by about 3.3% in dollar terms and about 10.8% year over year. While in constant currency, this growth was 3.6% and 11.6% respectively. Clearly, our results demonstrate our ability to do what is right for our customers and stay relevant and agile to their needs. Total income for the quarter was 429 crores, showing a sequential growth of 6% and 19.3% year over year. EBITDA margins for the quarter stands at 24.4 compared to 25.5 in the previous quarter. The 100 bps impact was mainly due to wage hike that was rolled out to a major part of our people effective July 1st of this year. It's important to note that we continue to beat our margin guidance of 22 to 24% in spite of above industry pay increases, payment of variable pay, and net addition in people, all areas where we have seen divergent approaches taken by other industry participants. After taking the increases as said, our EBITDA for the quarter stands at 105 crores, showing a sequential and year-over-year growth of 1.8% and 11.1% respectively. Profit before tax was 79 crores, 18.5% of revenues, and showing a growth of 0.6% sequentially. The marginal decline of 1.2% on a year-over-year basis was primarily due to the amortization of intangibles that came about from the acquisition of SMI that we did in December of last year. We are taking a quarterly hit of about 7.5 crores on this count. Profit after tax was 58 crores, which is 13.6% of revenues. Now switching to our numbers for the half year, like I said, our total income for the first half of the year crossed 100 million. Operating revenues grew 11.7% to $97 million, while in constant currency, the growth was 12.7% half year over half year. Total income stood at 833 crores, which was a growth of 21%. We continue to demonstrate good cash flow conversion with almost 98% of our EBITDA coming in as free cash flows. We ended the quarter with about 1,300 crores of cash and cash equivalents, which includes the 500 crores that we raised through QIP and the 35 crores that we raised through issue of listed NCDs. I'm grateful to all market participants for their continued support to the company. Talking about a few operational highlights, at the end of the reported period, we have 5,285 Happiest minds, a good addition of 237 over the previous quarter, which include joiners from campus. Our utilization has improved from 74.5% in the previous quarter to 76%. Attrition levels on a trailing 12-month basis have trended down nicely and now it's at about 14.4% compared to the 16.6% in the previous quarter, and a significant reduction from the 23.5% we saw a year back. As expected, our return on capital employed has dropped to 23% from the 33% in the previous quarter, primarily on account of the capital raise that I talked about earlier. It will be our endeavor, and this is our endeavor, to improve this return ratio by deploying capital into growth avenues like the new BU that we are creating, Ashok talked about them earlier, and establishing and also through acquisitions. I request all of you to go through the investor deck on our website, which is much more details and operational highlights. Finally, in line with our progressive dividend policy, the board of directors of the company have recommended an interim dividend of ₹2.50 per equity share. The record date for this payout has been fixed as October 30th. Cash outflows on this count will be about 38 crores. With this, I conclude my commentary, and over to you, Joseph.
Thanks, Venkat. A very good morning to all the participants in the call. We have yet again delivered industry-leading growth in the second quarter, which reflects the continued confidence of our customers in our value proposition. During the reported quarter, we acquired 7 new logos, with many of them being large Fortune 500 enterprises. Our continued ability to open doors across these large high-tech companies, energy conglomerates, and retailers emphasizes our value proposition. We continue to execute on our land and expand strategy, as reflected by the consistent increase in the average revenue per customer, which is at $804,000 now. We were also able to increase the number of large customers, as evidenced in an increase of our $10 million and $5 million customer cohort during the quarter. Now, I would like to share a sense of the conversations we are having with some of our customers. I'd be delighted to share that a leading global online retailer and hyperscaler chose Happiest Minds as the engineering partner to design interactive user interfaces and to provide automation services for their IoT platform based on our IoT cloud automation and product engineering DNA. With our mindful 4D framework, which is explore, envision, engineer, and enhance, we have been assisting companies in their innovation and digital transformation journey. For a multi-billion-dollar enterprise in the energy distribution sector, we leverage this framework to transform their document management systems for automated retention, intelligent search, and faster retrieval, thereby improving customer experience. Our comprehensive and integrated suite of solutions are helping our customers secure their distributed IT environment 24/7. During the quarter, a leading warehouse club operator in the United States chose us to provide security assessment services on threat modeling and application security. Companies are reinventing every part of the enterprise using technology, data, and AI to optimize operations and accelerate growth. For a large US-based utilities company, we have been chosen as a key partner to provide data engineering and governance services. We're working closely with alliance partners to deliver the benefits of digital technologies. And in one of a common customer, we are helping an industrial internet platform provider to build a data platform for their farm-to-table process using our deep IoT data and AI capabilities. Speaking a little bit about the demand environment, multi-year digital transformation initiatives are being broken down into shorter, composable engagements. That's what we've seen. This creates the right kind of opportunities for a company like Happiest Minds to exhibit agility, create value faster, and gradually expand into other related areas. However, in the face of macro and geopolitical uncertainties, customers are getting more prudent and seeking more bang for their buck and taking longer to take decisions. To accommodate this shift in preference and uncertainty, we have decided to revisit the guidance as alluded by Ashok earlier. With the creation of the GenAI BU, I'm happy to share that we are merging PES and BBS business units into one product and digital engineering services business unit as a first step in our strategy to verticalize and better leverage synergies and capabilities as part of our $1 billion goal by 2031. I'm excited to be given the responsibility to lead this integrated business unit and draw learnings across customers, better focus on white spaces, and take our land expand strategy to the next level. With this, I would like to end my commentary, wishing all of you a happy Dasara, and I will now hand over to my colleague Rajiv.
Thanks, Joseph. I'm really excited to guide this new function of GPS and work with a fantastic team led by Sridhar Manta, President and CEO of GPS. At Happiest Minds, we are known to take technology bets well ahead of time. Take, for example, IoT, which we started building capabilities well ahead of time around 2015 before it became a mainstream area of investments for the customers. We've been working since 2018 on the earlier form of GenAI as part of our AI focus. With a strong base of AI and analytics capability, the dedicated focus to GenAI will open up significant opportunities for Happiest Minds. Over the next few months, we will define processes and timelines to ensure that all of our 5,000 plus Happiest Minds get exposed to the practical application of GenAI in their line of work. The charter includes training on GenAI and develop teams to engineer business solutions. In outreach to our existing customers and showcase our prowess in the space, we're already working with 20 plus customers in the GenAI area. We want to strengthen and forge new partnerships in the alliance ecosystem, including working with Microsoft, OpenAI, Google, AWS, etc., and other open source platforms as well. A broader go-to-market strategy to the addressable market with our value proposition. Start tracking the financial parameters of GPS going forward, and we'll be announcing them for the next financial year as highlighted by Ashok. To conclude, we foresee that generative AI can be a significant revenue source for us in the years ahead and help us reach our vision of becoming $1 billion enterprise by 2031. With this, I end my commentary, and we can now open up the floor for Q&A.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Ashish Dash from Mirae Asset Capital. Please go ahead.
Hi, good morning. Thank you for the opportunity. So my question is on the guidance. So you have made a cut in organic revenue growth guidance. I wanted to know what happened during the quarter so that you got this guidance sharply, so from 25% to 12%. And also you mentioned last quarter that there is a recovery in the demand. You are expecting a recovery in demand in 2H. What is your view on that right now?
Yeah. Venkat, shall I just address the point on overall on the guidance? And then I guess really all the business people can talk about what they see about demand vis-a-vis any other statements we may have made. And so you're right in one sense that we've never differentiated in the past between organic and inorganic growth. We were certainly expecting, even as we began the year, to get almost a whole year of a very large acquisition getting reflected in our results. And therefore the numbers that we had projected were really not out of line to the extent that this particular guidance will indicate. On the other hand, we also know that getting an acquisition through is sometimes a bit of a uncertainty. You really don't know whether the deal will go through or not. This particular deal we're talking of actually has not gone off the table even now. And yet we don't expect assuming we even close it this year, we don't think we'll get any revenue out of that. So that is the major dramatic increase item which led to the difference in this guidance. Overall, there's no question that the markets have had declines. You see this in the results of all the entities who've been declaring their results, and in that respect, I'd say our result continues to be, as we said, an industry-leading performance. Some of the issues in terms of giving color to this as well as the demand outlook, I think my colleagues will take up for you, and I think it's really best if each of the three business units gives you the response to this particular point that you raised. I do want to add that we do see a need for giving a further thrust to growth. And that is one of the reasons why we have created this Gen AI business unit. It's a major change. We believe nobody's taken a change of this sort towards addressing this opportunity. It won't yield results overnight, but we believe in the long run, it will certainly play not only medium and long run, it will play a very important role in terms of taking us on to our declared vision of achieving $1 billion by 2031. So with this, let me pass this over to Joseph, Ram, and lastly Rajiv, because he can then also talk about the new business area.
Thank you, Ashok. And before I, talk about the overall demand environment, I just wanted to sort of give a little bit of context on Q3. I think all of us have to be cognizant that Q3 has a lower number of working days, which is around 3 days lesser than the other quarters because of Dasara, Diwali, and Christmas holidays. And we're trying to work our way through that. So I just want to put that as a context. Now, if you look at the broader demand environment, I see customers having enough needs and initiatives that they need to get done to digitize their processes, their offerings, and the way they interact with customers. So that's at an Uber level, and I think that demand is there. What we also are seeing is that just given some of the macroeconomic, I would say a little bit of uncertainty, but more importantly, at repeated intervals, some geopolitical developments. There's also a little bit of that. Let's take a look at what's going to happen, and instead of having large initiatives that they would typically have started, they're looking at doing things in multiple smaller packages. And this, as I mentioned earlier, works out to Happiest Minds' advantage because we're not looking for $20, $100 million kind of engagements. We're looking at engagements where you can go and work closely with the customer, validate some of their assumptions, doing POCs, pilots, and then take it to implementation. And while it elongates the sales cycle a little bit, it actually works to our advantage of a company that's more agile, that's nimble, and more of a partner than a vendor. And that's what we are seeing in terms of demand.
This is Ram. As Joseph mentioned, there will be, holiday season and, lesser number of working days in Q3. But that is also a period where a lot of budgets are going to be finalized for the subsequent year. And we believe that, the beginning of the next year will be much more better. And that is something which we are seeing in the market. Apart from that, what I'm really excited is about, our integration of PES and DBS business, which actually makes the IMSS to become a horizontal across all the verticals and thereby, enhancing our land and expand strategy. And also the GBS business, which will also bring a lot of generative AI capabilities in the IMSS space as well, whether it is in terms of service desk automation or in terms of security and infra operations, where Gen AI can be very easily integrated to provide better solutions for our customers. And that is what customers are also looking at. So looking ahead, with the integration of PES and DBS and also creating the GBS, I believe that there will be much better opportunities for us to land and expand in our existing customers and go after new business. Over to you, Rajiv.
Thank you, Rajiv Shah. So just adding to what Joseph and Ram said, yes, there is some sort of uncertainty that continues to happen, and there is a pressure on the macroeconomic environment. But given that, I think the kind of work that we perform for our customers and the value that we deliver, we continue to see a level of traction. They're still under continuous cost pressures. They still want to take the advantage of the newer technologies, OpenAI, ChatGPT, generative AI, etc. And with our platform of integration of low-code, data, AI, etc., I think we are in the right space for us to really create value for our customers. At the same time, you have larger integration opportunities as well. That is, customers are looking at optimizing their own environment, monetize their own set of investments. They continue to see more and more integration opportunities. So from that perspective, I think that the reason we set up the Gen AI unit is to really work with the customer, to really help them drive how to set up their own organization, how to increase consumption in their own environment, at the same time optimize their own environment to become more efficient and effective as well. So yes, there is pressure. There are disruptions that are affecting all of us. But fortunately, there is no cancellation of contracts or no real price pressures that we have undergone. But at the same time, the opportunities are there as well.
Okay. So one follow-up question on that. So you are saying there is no cancellations and no pricing pressure. So are we thinking that the inorganic contribution would have been more than 10%, but as it got delayed, so that contribution is not coming? And that is the reason? Or do you see that also you cut down your own organic growth guidance to 12%? Just wanted to know your view.
Yeah. Venkat, again, I'll take it, and maybe this time you may want to add a little bit. So the first really important thing is to say that actually there was never any distinction in our guidance between organic and inorganic. So we ourselves didn't internally say so much will be organic, so much will be inorganic. And largely because you got to visualize that when a company of our size is planning even a decent-sized acquisition, let's assume it's a company with $50 million. That's going to impact us in a very significant way. But if you take a multi-billion-dollar company, even if they do $100 million as an acquisition, it doesn't matter. They don't need to make the distinction. They may get a $100 million account, or they may get that acquisition. Either way, it will become a part of their growth story. Whereas in our case, it's a very distinct difference. It has to make a distinct difference. And, it's another matter that in the previous years, we managed to reach that guidance number in spite of the fact that we have really very little acquisition. Negligible, I would say. Here, obviously, while we were hoping for one, it isn't that we made the distinction even this year. So to that extent, it's difficult for me to say that because we had planned to say X%, but now we reached 12, that's a reduction. That is not the case. It was a composite total, and that is why we are now giving you a non-composite total, because we know the acquisition element is not going through. And therefore, we're giving you the number reflecting the current state of the market. Venkat, you want to add anything to it?
Ashok, I'm not able to hear Ashish very clearly, so that's why I'm not being able to.
But were you able to hear me clearly?
There is a little bit of static when you speak as well, but I understand this is about the guidance and.
Yeah, but if you've not heard it clearly, you go ahead and explain. Though I believe maybe we can ask Ashish whether he's got what he needed from my response.
Sure.
No, I got your response, but just a last question from my side. Do you still pursue the acquisition plan during 2H, though it got delayed?
Now you have to repeat your question. Even I've not heard you clearly this time. Just say that again.
Quite a bit of static on the line, I guess.
Yeah. Can you hear me? Is it better now?
I can hear you very clearly now.
Mr. Tash, I would request you to kindly use your handset, sir. Because when you use your headphones, there is a lot of static on the line.
Okay. Is it better now?
Yeah, much better.
Yes.
Much better.
Yeah, sure. My question is, do you still pursue the acquisition plan during 2H, though it got delayed?
Yeah, so very clearly I mentioned that in the very beginning, we clearly had an expectation of a very large acquisition. And I also mentioned that that's not gone off the table. But we don't expect, if you're considering the stage we're in now, if we've not signed, let's say, at least a letter of intent and begun due diligence, you won't get any revenue into this year. Maybe in a smaller entity, we may get a small bit of revenue, which is why we said additional revenue from acquisition, if any, will be above the 12%. But the larger one, if it's signed during this year, it will yield revenue only in the next year. So but it's not gone off the table. That is the good news. And hopefully it will come through.
Okay, thank you so much.
Thank you. A reminder to all the participants, anyone who wishes to ask questions may please press star and 1. We'll take the next question from the line of Sumit Jain from ICICI Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just want to probe on your guidance. So actually, if I look at your 12% organic growth guidance for FY24, that does imply a CQGR of around 5 to 6% for the second half of FY24. So just want to understand, what gives you confidence of a sharp revival in growth in second half, given overall weak macro environment from the discretionary spend perspective.
Venkat, you want to handle this? Hey, Venkat.
Yes, I just joined again because
So did you hear the question from Sumit?
No, I didn't hear.
I can repeat maybe.
Yeah, Sumit, please repeat it for Venkat.
Yeah. So basically, I just wanted to understand your guidance of 12% organic growth in FY24 does imply close to 6% CQGR for second half of FY24, which is obviously a sharp revival of growth, what you are assuming. So just want to understand, what is giving you that confidence? Is it the current order book or, certain top clients increasing their spend? Just want to understand what is giving you that confidence.
Yeah. Sumit, so the first half of the year, we have done 12.7% in constant currency. That's half year over half year. So we are hoping to continue a similar trend of growth for the next 2 quarters, and that's how you get the 12% for the year. So I didn't look at the CQGR, but if you look at it, you have to continue what you're doing right now for the next 2 quarters. This is essentially coming from, the repeat spend, the repeat client business that we are getting, the pickup in business from the new logos that we have signed up. 7 logos this quarter, 13 the previous quarter, and 14 the quarter before. So it's been a strong sign-up that's happened. It's been taking a little while than what you would have expected maybe a year and a half back on the ramp-up. So those aspects have been considered. And most importantly, the 2 less working days in this quarter. So we have to really, take some alternate steps on that, making a Saturday working. We're working with the project teams to make sure that we're able to make up for those lost days, because a day is close to $700,000 in revenue. So we have assumed all of those and a repeat of the first 2 quarters, reasonable repeat of the first 2 quarters, and that's how the number of 12% comes from.
Sure. Sumit, in summary, that actually we're not projecting any major increase in the quarterly growth in the second half of the year. We are literally saying if we did what we've done in the first half, at least then we will achieve this number. And there's no reason to believe it, certainly that we will not be able to do that. But of course, that's still a guidance.
Okay, got it. So secondly, you want to understand, you guys obviously are sitting on a significant amount of cash for the QIP. So what kind of M&A candidates are you currently evaluating in terms of capabilities or industry verticals?
So maybe I think we could really get Joseph to talk about the angle of types of capabilities. And then if you, because we do know the size is a reflection of the fact that we raised cash to do a big one. But maybe Joseph, you could talk about the types of things we think you're interested in. And it can be so many of them for that matter.
Sure. Yeah. So, Sumit, there are multiple, angles that we're looking at when we are evaluating or even shortlisting acquisition candidates. The first one is looking at from a domain angle, looking at where we can, vertical angle, where we can get companies that would fill in white spaces that we have from a subsegment standpoint, right? If you take, let's say, BFSI, in BFSI there's insurance, in insurance you have reinsurance, corp insurance, and multiple kinds of things. So we've identified a few white spaces in terms of our subsegments or subdomains where we would like to strengthen our capabilities. So that's one, huge angle that we are using. The second one is again from a technology standpoint. There are white spaces, whether it's in, some of the low-code, no-code platforms, some of the data and AI platforms and products that we are partnering with, where we would like to have more skills and more customers and revenue. So that's the other one, the technology part of it. We're also looking at it from how it can get us into some of the named accounts or large customers that we have as a target, and if you look at the SMA acquisition that we made, it led us into a customer that we had been targeting for some time that got us into the healthcare space, where they were the largest vendors for a long period of time, and hence understood the customer environment. So that was the other, that's the third angle that we're looking at, where it gets us into a short list of customers that we want to break into. That can also map onto the first two parameters that I talked about. And the fourth, which is, which is good to have, is more about does it give us capabilities or market presence in a new area that we've not, a new geo that we've not been in. But having said all of that, I think the common parameter or criteria that we use is to ensure that whichever company that we are considering, there's a good cultural fit, so that from an integration standpoint, we don't run into challenges.
Sure. And if I can add, Sumit, I think it's equally important sometimes in an acquisition to be clear what we will not do. So one thing we are not going to go and do is to do anything which takes us away from our 100% digital positioning, or 100% digital business. Second is we will not do something just for the size of scale. Third, though we will look at areas in AI, which is important, we are not going to look at saying, hey, the latest area is now Gen AI, let's go and acquire that capability. We believe we will build that capability. We're going to build an organization, and we are already doing that to build that capability. This will be wrong to go out and try and leverage on what others are doing. This has to be done very closely linked to the nature of our business and add to each one of our industry groups. So that's something we will build ourselves. And within that, you can add to it the areas that Joseph said we will do.
Got it. That's helpful. And just last question, maybe for Ram. I can see your infra management and security services business line has been now flat for last 6 quarters. So can you explain the reasons for the weakness and when can you see the ramp up happening in this service line?
Yeah. Actually, what had happened was one of our large customers had some difficulty in their business, which reduced some of the revenues for us. But on the other hand, we have been growing and making up for all those revenue reduction which happened. So that's the reason why you are seeing flat. And as I told you before, we are seeing a possible growth in this particular account as well in the future. So we are hopeful that, we will be able to continue our growth starting, Q4 of this year. And we are also seeing an increased demand in the security area, which also we believe that we will be in a position to make up for all these issues which we had with respect to growth starting Q4 of this year. Sorry.
Still a very valid observation, and I'm sure now Ram is coming into it from a period of confidence, because it has been a stress, the fact that we've had this well-observed statement of yours that, yes, there's been a softness for several quarters in a row. But it takes time sometimes to revive from that when you've had a setback for no real reason. It's a reflection of the customer's own business. But that business is a steady, robust business and is now beginning to get back into giving us the sort of business that we were used to getting from there. Plus, of course, exploring many new opportunities, which have taken time to build up. Would it be right to say, Ram, that we've signed a few contracts which we hope will grow? Because it takes time for an account to grow, and it's those new accounts which will then make up for providing growth even while the account which went down still takes a quarter or two to revive.
Yeah. The new deals which we have signed up, though we have started small, there is a tendency to grow these accounts because the services have been good, and also our customers are seeing the growth happening in their segments as well. So the new deals which we have closed in the last couple of weeks, we believe that is going to grow in the next couple of quarters. It will start seeing growth, and that is the reason we are confident that we will be able to grow as usual in the past, starting Q4 of this year.
Got it. That's helpful. Thanks for taking my questions. I will come back in the queue.
Thank you. Before we take the next question, a request to all the participants to please pick up your handset while asking a question. This is required to ensure optimum audio quality on the call. Thank you. We'll take the next question from the line of Dipesh from MK Global. Please go ahead.
Yeah, thanks for the opportunity. Just one clarification. SMI acquisition we consider as part of organic revenue growth guidance, or it would be additional? Because last year it added for about a quarter. So just want to get that clarity. And second thing is about the M&A. We are pursuing M&A for some time. No major progress so far. So what explains in terms of whether the valuation mismatch is driving some kind of delay in closure, or in terms of the targets are becoming difficult considering their performance might have suffered considering overall macro uncertainty? If you can provide some reason which explains delay in some of the deal closure. Thanks.
So I guess Venkat and Joseph, both of you could respond to that.
Yeah. So we closed SMI last quarter and last quarter of last year, adding in about $2.4 million into revenues. Part of that has been taken into the organic growth, which is how we have planned. And if you look at it, Technically, also, it is organic because they came in with 3 good accounts, and we have been growing on the base of those accounts in this year. With respect to the M&A delay, Joseph?
Yeah. So, what I would say, Dipesh, is that we've almost on a weekly or bi-weekly basis, we've been in conversations with customers, and where there have been 2-3 reasons why we've not been able to get a closure. One is, I think some of the companies that we spoke to, we didn't feel that there was a cultural fit out there, and we did see this in integration, and therefore we didn't move forward. The other reason why we were not able to close is that some of these companies also had Ps as private equity funds that were pursuing them, and they tend to be much more aggressive than we would be in terms of valuation and our comfort. And the third is, we also saw that there was some difference in the deal structure in terms of what is the upfront and the earnings component, and so these are some of the reasons. But having said that, we did hope that the current market conditions would get some of the expectations from acquisition candidates to a manageable level, and by and large, we've still not seen that. But we continue to plow away, and as I said, we are in conversation almost on a weekly or a bi-weekly basis with acquisition candidates, and we are the Ashok and the board has made it clear that we need to really deliver results out here, and so Venkat and I and the rest of the executive board are seized of this matter, and it's something that we are working hard on.
Sure. Well, I'll add just one thing, which may be a bit of a consolation for ourselves. If you see the way valuations have gone in the industry, as reflected not only by the deals, but by the market cap of the companies who have got, in the industry, and you can see that these valuations have declined enormously. So if we had bought something 2 years ago, we would have been left with an asset which is reduced maybe 40-50% in its own value. This is what's happened to the entire industry if you look at it. Now, so that's a consolation. This may just be the right time. There's also another angle, and this is the psychology of the person who's come up for acquisition. That person also says, look, I could have got so much more 2 years ago. Now, why am I going to settle for less? And there's a little resistance then to accept what we believe has been a realistic valuation offer. So it is an exercise, but we're learning, and there's no question that sooner or later we'll strike that one big deal. And these things, in a sense, it's more important to get the right one than it is to say, hey, okay, sure, we didn't get that growth in the previous year, but it doesn't matter. It's more important that we get the right deal when we do the deal. And again, as Joseph said, we're clearly very much focused on that task right now.
Mr. Dipesh, any further questions?
No, thanks.
Thank you. We'll take the next question from the line of Gauri Mishra from Narottam Siksaria Family Office. Please go ahead.
Hello, am I audible?
Yes, ma'am. Please proceed.
Good morning, team. Actually, all my questions have been answered while answering Ashish, Dipesh, and Sumit. So I kind of don't have any more questions.
Okay, thank you.
Thank you. We'll take the next question from the line of Anand Sudhani from Sudhani Securities. Please go ahead.
Hello.
Yes, sir.
Hello?
Please proceed.
Yeah, good morning. Hello. You see, I am Anand Sudhani from Sudhani Securities. I am a retail shareholder of your company. Seeing the results of last 5 quarters, and it's always coming flat and flat. So in the expenses column, we are seeing the finance cost is every quarter more than 1,000 crore is the finance cost. So can you elaborate on what does the finance cost include? I mean, is it the pledge, the shares which have been pledged by the company? So does that add to the finance cost?
I'm not sure. Are you talking about the revenue being flat, or are you talking about the share price being flat?
No, profit. That is flat, right? Quarter there is no growth.
Okay.
There's no growth. The revenues are improving, but because of the finance cost, I mean, the expenses are going every quarter. The PAT is coming flat, right?
There's some statement you made which I'm not sure what bearing it has to your question and whether the pledge on the shares is relevant. I'll just give you the absolute data. The pledge is being eligible. The pledges were a very good cause. I'm funding a not-for-profit research entity, which is, and putting a lot of money, and that entity is going to be a showpiece for the whole country. So it's a very valuable entity being created. There's no speculative process here. My shareholding still remains at 51.3% versus the fact that he said I would at least always keep it above 40. So I'm not sure whether that question has got any bearing on what your first part of your question, but let me get Venkat to answer that for you.
Yeah. Yes, Ashok, thanks. So, Anand, like Ashok mentioned, pledges on a personal side, Ashok as promoter has pledged a very small portion for continuing to raise funds and some interim gap financing that he is doing for the activities that he just mentioned. That got no cost on the company. So that's one. Second is, if you come down to our PAT, you should not look at interest costs in isolation. You should also look at the money that it generates. See, the average cost of funds for us, interest cost, which we pay is about 4 to 5%. Our other income is generating 7.49% because we are about 95% of our money or 99% of money is in safe fixed deposits. So the arbitrage is one. Second is the funds that we are raising is to obviously build, a sort of corpus for the acquisitions that we're talking about. This is the interim place where we are raising money through capital and through a little bit of debt, which will then be deployed on acquiring companies where the return on capital will be more than 20%. If your cost of funds is about 7.5%, you are able to generate 22-23% on the capital that you employ in an acquisition, or for that matter into your existing business or to a new business. That will generate the alpha return that we talk about on the company. So that's the reason. The drop for profitability year over year, if I should say, is because we have taken close to 8 to 9 crores of intangible write-off this year because we had a couple of acquisitions. We follow quite an aggressive way of accounting for the split of the purchase consideration. We have acquired the company SMI and before that PGS, and there is a significant part of that purchase consideration which goes and sits in our intangible. We don't put all of it in goodwill. So there is an assessment which is done. Based on that, it goes into your intangible, and the intangible is then written off over 5 years. We don't carry it. So if you really look at the PAT number, you should compare it to the cash flow that we talk about. So 98% of your EBITDA going back to cash has to be seen in line with that as well. So there are leverages that are there in your financials. Second is, year over year, on the EBITDA front, we have taken a drop. No way. There's no two ways about it. Primarily because we have divergent, like I said, unlike other companies, we have met our commitment to the campus joiners. We are making investments into the business in terms of people. We are giving pay increases. So if you have seen our competitors or comparators, industry participants, other industry participants as I like to call it, they've all deferred their pay increases. They're talking about headcount reduction. compare that to what we are doing. We are increasing our headcount. We are making investments.
I don't think we should say that all have deferred pay. Some may have done and some have been lower.
Some of them, some of them have deferred the payout. Some of them have made differences in how they do their, variable payout commitment and how we take them. So there are divergent approaches being taken with intention to, manage that cost. Whereas we, keeping in line with what we see as we've been saying, building that $1 billion company, the platform is being built with investments being made into the company. And it was with that in mind, we had always made this guidance of 22 to 24%. While we were reaching 25, 26%, it would not have taken much to say, hey, we are upping our guidance to 25%. But we always mentioned that we would not sacrifice future growth possibilities by not making the investment that is needed today. So you have to see all of this in conjunction, and you will get that will give you a better fit of the company that we are trying to build and the organization that we are trying to build.
Sir, the participant has left the queue.
Okay.
Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Sunil Gujjar for closing comments. Over to you, sir.
Yeah. Thank you for joining us today. We thank ICICI Securities for hosting this call on our behalf. We look forward to interacting with you. You can reach out to us at ir@happiestminds.com. Thank you.
Thank you. Thank you, sir. Thank you, members of the management, ladies and gentlemen. Thank you, sir.
Thanks a lot. Bye-bye.
Thank you.
Thank you. Bye.
Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.